This conference will now be recorded.
Hi everyone, it's Patrick Reed from the Adamas Principle. We have got a very special show tonight. It's a central bank special. It's making sense of central banks. Now, James Athey put a comment on my LinkedIn post saying, I kind of alluded that I'm going to be making sense, and whoa, we are going to be making sense of central banks. I'm not so sure about that.
No.
I'm not so sure about that. We've done a very crude. Well, I made a very blunt attempt at a very crude ranking of central banks based on an arbitrary set of pros and cons, and that will come a bit later in the show. But I think at the moment, like last week, I got something handed to me, and it wasn't money. So I feel the something happened to that, and I posted about it on LinkedIn, and I just want to really quickly go over it. We spoke offline about this, but so here's the thing, right? We had a patient fed. That's not really an original term. It's been used lots of times before, and dollar got hit midweek. Then we had a Goldilocks scenario with US GDP at 0.4 higher than consensus. You had a nice fat Chicago PMI, I think it was around 64, and this took dollar yen much higher. So I think the thing I looked at was there are two things. Dollar snapped back above two key levels. One was on dollar CNH, which was 6.7, the big figure. It closed above that on the daily. And the other one was dollar index. And that was, it closed above the 200-day moving average. I just want to check that for myself. Give me a sec, because I haven't seen it for a while. Just bear with me. Yeah, so we're just above it. It's 96.22. So the thing here is the dollar index is weighted predominantly with euro-dollar. Euro-dollar didn't do much. Dollar yen did. And in my eyes, that carried it. So because it's got such a small weighting, that doesn't happen that often. And it's significant. So I just want to flag it out. I just want to put it out there. And I just feel that we're in a very much, all of the global worries have not gone away. We've got a chorus of various levels of dovishness or neutralness, both EM and DM central banks. And that has just lifted risk. And what this has told me, in the sense that dollar yen was the big mover, it was the big story for me last week. And because euro dollar didn't move much, dollar yen lifted euro yen. Aussie dollar didn't really do much after the figures, after the two sets of data. But Aussie yen, got lifted, and it was a yen move, and it was a dollar yen higher. So I just feel this is quite significant, and I also feel, before we sort of go into the sort of central banks and stuff, I also feel again the market has a taste for risk, and I think it's wrong, but I'm very worried about it, and I just feel there's a lot of stars aligning to be buying into that risk. You've got the data, which was the Goldilocks. Any strong GDP is perfect for, it can lift 10-year yields, which it did, lift dollar yen. It means that the Fed doesn't have to jawbone, patience or pausing on QT and all this stuff, gets Trump off his back. I know we talk about its independence. It is independent, of course, but it can't hurt. You've got Fed put buyers anyway who are kind of milling around the stage. ready to get center stage to start buying again because they're frankly insane. But all of this and buying the rumor on the tariff delay. And you've got a good share, you've got a great Q1 so far on equities. And also we've got, everyone's kind of going all kind of dovish. You had the RBA, you got the Bank of Canada that kind of half blinked. The Bank of England, I mean, they've got some bullets, but they're not going to be hawkish, are they? So,
No.
I just think it all fuels into this taste for risk on. So I'm worried about it. I don't know what your thoughts are, Beat.
Like we quickly spoke off air, and what I was blogging last week about, I'm not quite so sure about what move we're actually witnessing. We have what we talked about. We have the inconsistency between emerging markets and G10. So we have like sort of what looks like a naive carry rally on the one hand, and we have a very concerned emerging market side. So we have dollar rand rallied 4% off the lows, dollar Turkey 2%. And, like we said earlier, if this were to be a dollar view after US GDP, whether that be a worry that actually, maybe it's not a pause, maybe one hike is going to sneak back in from the Fed, then equity shouldn't be that big. Or G10 dollar should be more big because we still have to overcome the strong negative carry of buying dollar emerging markets. So the inconsistency between emerging markets actually selling off versus naive carry bid starts to tell me this, what we've seen in the yen is pure flow driven and not the true carry risk on. If we look at Aussie yen is 79.30, 0.5% below the double top. So actually, if you look at risk on, yes, it rallied back a little bit, but in terms of what we've seen in the last few weeks, not much has happened. The only space where it really happened was in Canada yen, but that was taken care of by the weak GDP data on Friday. And what you rightly pointed out is dollar yen. Now, with euro dollar just doing not a lot, and we had whatever was going on. And the other reason, actually, what I want to mention is Swiss yen. Swiss yen had a very big move last week, which looked like for a long time like being a month-end rebalancing flow. Swiss yen moving such a distance without actually any news whatsoever. It moved about 1.5%, which is a lot for that cross, out of nothing. So to me, last week, I start to think was a big flow out of Japan. There was one story that was going around about Nippon Life starting to increase treasury holdings unhedged. I've seen some other stuff about 2 weeks ago, I think another lifer. So what we have to be careful now, I'm not saying what you said is wrong, but if I see a very predominant single-handed move that is really just a yen, and I can confirm that because of the Swiss yen move, that there was just some yen selling and it probably came out of Japan. Whether this is truly what we think, we just look at it and go like, oh, it's risk on. But with so little going on in the market, if some bigger one-way flow is hitting the market, we move and we all try to draw conclusions from it. The reason why I'm not yet prepared to agree, even though, I sold euro yen into this rally, dollar yen into this rally, Swiss yen into this rally, Canada yen into this rally, because those are the levels I set out in January. Yes, I'm a little bit concerned that I'm going to get stopped before we finally get the trade deal, because obviously the yen is weak for some reason. But when I then look at the emerging market side and some of the other stuff, Aussie is depressed, right? It rallies actually into the open, as I just see. It's up to 71, close at 70, 80. But, some of the currencies are not really that kind of risk onish, if you want. So I don't. Dollar yen, without a shadow of a doubt, has reacted very strongly to the data, US data. Sold off, if you remember, on US retail sales quite a bit. It sold off on goods. It rallied on US GDP, it rallied on Chicago PMI. So dollar yen has suddenly become this sort of overdrive barometer of US data. The euro dollar, and as you know, I'm a big cross watcher. You just saw that there's no reason for euro to really go down a lot. There was nothing going on, and it just sits there. And so the cross is just moved by default. And I don't really see, the moves being carried as, oh, I'm bullish euro yen, I'm bullish this, I'm bullish that. It just kind of, it just happens, right? It doesn't trade, it just grinds, which is another sort of sign that there's real flow going on without anyone going against it. So at the end of the day, you have to accept when we break higher, I have to accept it. I stopped myself out above 127.5 in the euro yen, above 112.20, so around actually 112.30 in dollar yen, because I just have to manage my risk. But do I believe 1 minute in these moves? I struggle. If I would see emerging markets bid, so I see a theme of risk on, and I see a broader kind of Goldilocks, oh yeah, it's good to have risk, blah, blah, blah. Even rand yen went down while euro yen goes up. That makes no sense whatsoever if we want to talk risk, right? Because every emerging market guy would be all over buying rand against yen if he sees G10 yen is weakening, right? So that just, to be honest, if it stays like this for a few more days, I have to accept it. Right now, I just feel there has been some very large one-off flows in yen. And like the other day, when was it, Thursday, where Euro Swiss drops 50 points and Euro yen goes up 70 points without actually any, nothing that would actually make you believe. We have these moments. Swiss yen is a great cross to understand where the funding currencies is moved to. What we sometimes see is that when the market gets unsure about the yen side, that they park the funding into Swiss or vice versa. There's no real evidence why you want to kind of change funding currency as aggressively as the market did. So, what I see, because I've watched so many different elements of the market, I see complete inconsistency across. And that's why, yes, the yen has weakened. Is it risk on? Who knows? Because now we have Aussie yen isn't too impressive. Canadian got smashed after the weak GDP in Canada. Suddenly it's just euro yen hanging in there. Euro yen might not be your traditional risk on, risk off currency, even though, yes, it moves with risk, but it's not kind of your traditional cross. So it leaves me really more questions than answers, if I'm honest. Right? The inconsistency is what concerns me. And I have more respect from emerging markets. Why? Because before you start trading rand and Turkey and that stuff, you have to think a little bit more than if you trade euro yen, right? It's easy to buy euro yen, sell euro yen, whatever. But before you trade emerging markets, because of the liquidity, because of the sharper moves, volatility, the spreads, you think usually twice.
Okay.
So that's why I respect.
Yeah.
If I feel the market as a kind of vacuum in understanding, or vacuum of actually knowing what they think, I tend to lean towards emerging markets and give them more credit, right or wrong, I don't know, but it's what I've done all my life. And, don't forget, you have Turkish rates at 24%, you have rand rates at 8 or whatever percent. So if we were in this bullish world and everything is honky-dory, guess what? I want to own the 24%. I want to own the 8%. I don't want to breadcrumbs like, Aussie having like 0.2%. You know what I'm getting at? So that's why.
Yeah, exactly.
And or if dollar EM is so concerned about the US data, and if it's the dollar that it's driving it, then stocks can't be bid.
Yeah.
If dollar emerging market starts to rally out of concern that the Fed hike is coming back suddenly on the radar, then stocks shouldn't be bid. It just doesn't go both ways. And so whether that means the market is just too confused and we falling, and that's why I just say we should be careful that we not fall for price action. Something that just happens because maybe it's overhang from month's end flows. Don't forget, Friday was only just the 1st of March. So if we had some large flows in this back end of February, you could easily have gone into, March 1st. But Monday, Tuesday will be the proof is in the pudding, right?
Yeah.
So if the moves continue, then we can't blame month's end, we can't blame rebalancing, and then we just have to sort of accept it. I'm definitely not going to go long. If I get stopped, then it puts me out of the misery, so I can put my macro view aside for a moment and just regroup, which would be a nice thing as well, because I'm looking at the same story for the last 2 months, actually last 4 months, of which two worked and 2 didn't. So it's about, that's where I'm just standing. So I haven't really taken all the conclusions yet. I don't trust what's going on because of the inconsistency.
Yeah, I mean, I sort of, as ever, when I talk to you, I get more questions than answers for myself.
No, it is. It is.
I'm
that's the type of market we're in.
Yeah, it's very difficult, and we do get institutional viewers, but some retail as well, and I think this is where risk management comes in. It's knowing when to stop trading, and I've got a couple of little projects I'm doing this week. I'm not trading this week, so that it's markets. I just remember, I've been around not as long as you, Beat, but I've been around a little bit. And I've seen, I remember rallying markets. I remember just buying into dollar yen after the victory speech, just thinking, this is never going to end. I mean, it went on and on. It was around 101, and I was just thinking, this is gravy. This is insane. I couldn't understand it, but I did. I was buying boots of it, and it was bits of boots. Only had retraced, but then it, I think it was at least 10 big figures later or whatever. It's but now, at the time, I remember thinking, this is how markets are always going to be. And get in that world, like the dot-com boom or 2006, 2007. You think this is normal.
Yeah.
The QE, the bonds, the bond buying in QE, in that, when there was a wall of money and the ECB was around just shoveling trillions of dollars around, and it was just, you could just buy anything. And
to be honest, the one thing I discussed with someone today is, let's not forget one thing, that's just reality. We have a lot of people now in the market in fixed income that have not been around prior to 2008. What we have now is suddenly a Fed that doesn't give those people forward guidance. So most people were used that the Fed has taken them by the hand, told them exactly what's coming, blah, 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 right?
Yeah.
So now we suddenly have a market, and I think the move in yields up and down is maybe a little bit, a sign of that, is where suddenly we all look at the same thing. So the interest rate traders no longer have the Fed that exactly tells them when they do, what they do, blah, blah, right? Now suddenly it's like patience, waiting, watching data. So what we have now is we inject a little bit more volatility into the interest rate market, which may feed into the FX market, but it's two-way risk because we are just at a point where we cannot for certainty say which way the data is going to go, right? We can feel where the data is going to go, which is probably lower because it has to sort of manifest itself. GDP, let's not forget, as much as I pay attention to it as well, is a history lesson, really, right? It's Q4, we're now in March, right? So to put too much weight on the GDP from the fourth quarter is probably wrong. because the Q1 GDP is probably closer to 2, the way it's. So we have to be careful in terms of, appreciate that there's more volatility injected by the Fed because of its current stance. So obviously the market struggles a little bit to find where this is going. In terms of divergences, the easiest FX trade is we can buy one that hikes and we sell one that cuts. Right? That's the easy kind of FX trade. Or we buy if someone is hawkish and we sell against who is ever dovish. Suddenly we have a bunch of central banks that are lining up again, right? Why did the euro never move? The euro could actually not move. It didn't adjust for the Fed going neutral. Why? Because the European data came off at the same time and the ECB has gone dovish at the same time. So we have not opened a fresh divergence between the Fed and the ECB. Then the RBA has gone dovish. And so we kind of have nothing new, really, in a sense that is really driving effects. That's why we are in the ranges that we are. Hopefully we can break up, but something has to give. And at the moment, nothing gives. If you would have one going hawkish and the other one stays dovish, that'd be a trade. But we don't, because same even for the Aussie. Let's say the Aussie had the potential for a moment to maybe adjust on the upside thanks to the sort of less hawkish Fed. What happens? Weaker China data / dovish RBA. So that's trade gone out of the window as well.
Yeah, that's right.
We don't have enough negativity right now so that the Aussie can break that 70, 60, 70, 70 level. So what are we? 70, 50, 71, 50 in the Aussie. We like something like, I don't know, 113, 114 and a half in the euro. And I can't see an end of it. I can't. There's nothing out there other than either Trump gets in trouble, like something I was sending out earlier. There's a few clouds on the Trump sky. Whether that eventually leads to any issues with Trump, we don't know. It's really hard. And that's just reality. And you said something very important, and I said this to someone today. I said, no matter what our views are, no matter what, if you're bullish, bearish, whatever, the reason, why this is the reason why we do risk management, because sometimes it's wrong, and the market, maybe I'm wrong completely. Maybe risk rallies all 2019. I don't actually believe it, but let's just say it could. Yes, that's why I have my stops, because at some point I have to go like, what? Maybe this whole thing is delayed by 3 or 4 months, and we get the usual hiccup in summer. We don't know. But right now, I would just say to everyone, just keep it, stay disciplined, because, I would say even the people that usually have a bit of an idea or more of an idea what's going on struggle. It's not just you and me. It's like other people that I respect that just look at this, go like, don't know, right? So we all try to have a view, try to keep our positions, but there's a lot of random stuff going on, which just can be here to stay, really, sadly.
Yeah. I guess the other thing is, when I was saying before about the 101 and dollar yen, it will change eventually. Probably goes on longer than I like or you like, but eventually it will find a new narrative, a new direction.
Oh, yeah, absolutely.
And what that is, I don't know. But I guess, it's interesting. I sort of overlook I do this. This is one of the things that it's a weakness. It's my Achilles heel. I forget the end of the month, and I've been hurt a lot of times. So I need to beat myself up about that. So that's something we can always improve on. And I really take on board what you're saying about EM. Should if it's proper risk on, and the fact that it hasn't really rallied after G10. So and it could be a massive flow. That Nippon thing you were talking about, that all makes sense.
To be honest, the thing usually with the Japanese is if one guy is doing it, a few others doing it. That's just how they operate. So it could just well be that, you know what, 10, $15 billion were allocated last week. That, you know, and even euro yen, you know, is maybe just, you know, like you know, the crosses we discussed. Dollar yen
Yeah,
goes up, euro doesn't move, euro yen goes up by default. If you now just watch euro yen, you think like risk is big. But actually what has happened is just because there's such a concentration of flow in one
yeah,
pair, and the others don't move because they don't need to move because there's no story, which even
yeah,
more confirms my idea that it could be a one-off flow. That just pushes all the crosses up, right? And now it's about, you know, this week is going to be about, okay, let's show what this is, right? So either euro dollar comes off and the dollar rally is broad based, because one
yeah,
thing we will not see, even though I appreciate what you say, that it's important that, let's say, the DXY performed somewhat thanks to dollar yen, given that the euro is the biggest part of DXY, I could not see that the dollar could continue to go up and the euro continues to do nothing. You know, like
yeah.
at some point, you know, whether it's tomorrow, whether it's Tuesday, Wednesday, and that probably brings us into the ECB discussion quite nicely from
Very
Thursday.
nicely dovetailed. You're trying to like uh, do my job for me. That's very kind of
No, I
you.
just realized it's kind of, I suddenly arrived somewhere where we actually want to talk about.
Absolutely, yes.
I
So
couldn't finish the sentence.
absolutely, absolutely. I'm just getting my. I just reloaded my TraderMate, which incidentally, little plug, TraderMate, absolutely clean, classy, and very good for spot effects. So I'm just getting this sorted out. So, shall we talk about this week for a bit, and then we can do our little "Who's the best central bank in the world" rank. So I think there's lots going on. I think you know, the Fed kind of started it, the kind of neutral dovish. Everyone ducked for cover under the FOMC canopy, and I think the ECB. Every single person I can think of is telling me the ECB, they got to be dovish because the data's shit, right? Everything's rubbish, and everyone else has gone like that. They surely have to do something. Verbal intervention, forget the king of verbal intervention. That's gone.
Yeah.
You know, Jay Powell's taken that hat over because let's face it, right? The FOMC has not actually done anything. QT's still on board. It's about 50 yards a month. They haven't actually said we're not hiking. You know, the OIS has priced it out. ED Futures is priced in a cut. But all he's done is said they're being patient. So I say Jay Powell is now the king of verbal intervention. And Draghi, what's your next move, mate? That's
Yeah.
what I say. What have you got? When you could have hiked and you didn't on your single mandate, what have you got now? You got Teltros? No, that's not going to do it. It's got to be something pretty good. So, I mean, I see you get some weak shorts going into the meeting and then a big disappointment. What do you reckon, B?
Yeah, to be honest, I was waiting on Friday for the usual M&I sources story. That usually comes on a Friday before the ECB meeting the following week, just to kind of tee us up in case there is a change. The lack of that story to come out on Friday tells me there's no change. The ECB is gonna, you know, let's not forget he was a little bit more dovish in the last meeting, so versus the one before. So that's why he sold euro on that day. But I don't think it's going to go any further right now than that. They're gonna acknowledge the data, but in terms of the data, they could actually say, you know, if you look at the PMIs, they're kind of hanging in there now, so they didn't go that much lower. CPI was as expected, so it didn't go any lower. So I think this meeting they're going to sit out and, you know, play for time for the next meeting. The next meeting would be the one where they would have to announce if they want to kick the can into 2020. But I think you rightly say that I think the market could be too bearish for this meeting. So that leaves probably the room for, you know, euro to bounce back to 114.5, whatever, just on the short covering. The other interesting story I was reading last week, which I actually haven't thought about, is there's a lot of talk in the emerging market world to actually use, and that's probably not only just started last week, it started probably already way before that, to use the euro as a funding currency, which is a better funding currency than the dollar. Because obviously, you know, you have two dovish central banks, or let's say not so hawkish central banks, but the euro price to fund is a lot cheaper now than the dollar.
Yeah.
So that could be what used to be, you know, short dollars versus yen, it could turn into short euro versus yen. So we might actually have a few more euro shorts than we are aware of, should the euro squeeze. But having said that, do I expect it to bounce more than 70, 80, 90 points? No, I don't, because there's no reason to buy the euro either. So, but for short-term trading, I don't think there's any value to be short euro into the ECB. I don't think, I fully agree with you. There's a risk that they under-deliver versus market expectation. If they were to kick the can at this meeting, I would be shocked, because that would then tell me that the ECB has given up forward guidance, which they haven't yet told us that they will. So I would rather expect the ECB to communicate, okay, data dependent, blah, 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 rather than just kick forward guidance out by not telling us. So if they were to kick the can on rates, I mean, euro would get hit very hard because it'd be a surprise. Even though I would say not even those people that expect the ECB to be dovish expect rates already to be kicked into 2020. At least I haven't read it, so maybe they do. But you know, everyone who is a central bank watcher will know the same thing, that is, the communication has not pointed to that, nor have any of these M&I sources pointed to that. So no one has made any noises from official side that this is a risk to happen. And usually they're pretty good in communicating, or let it slip, or whatever. But I personally didn't see any ECB speaker that would make me believe they're going to kick the can this meeting. I think they're going to wait another month.
I just don't see the ECB raising interest rates ever right now. Nothing. They've just thrown $2 trillion at it. Nothing's happened on CPI. It's dead. So what? And then you've got a broken system that was brought together because of, not through economic reasons. They let in some countries through the back door with some very ropey books, and now you've got France, Italy. Greece is still a nightmare, but no one's talking about it. I don't see where's Germany's creaking. It's going to have, as we mentioned last week, it's getting hit from the China thing because of the exports. Where are you going to hike? When and what are you going to hike? I mean, I don't see. Can you imagine them doing QT? I mean, I don't see it. So why would you buy euros?
No, there's definitely, the euro could only really rally if there's a problem on the dollar, and there is no problem in the dollar right now. There's probably no reason for the euro to collapse, because like we just pointed out earlier, everything is kind of priced, right? So whether we feel it's correct price, but given that the euro dollar had a sort of hawkish Fed in December, a dovish Fed in January, a sudden more dovish ECB. So we had everything. The euro couldn't move because everything just kept on balancing itself out. So On the flip side, I can't see a reason why euro should go on 10 unless euro data gets a lot weaker. Like right now, I think we are priced for where we are. What we know from data, what we know from central banks, and it's 113 or 114, and something has to give for that to change in a meaningful way. And I just can't see it right now, unless suddenly the US data does turn down quite significantly, and then suddenly this broader dollar weakness could suddenly be up on us. But again, for that, we do what the Fed is doing, watch data.
Yeah.
But I think on Tuesday we have the European PMI, so that gives a little heads up. What's going to be interesting, which I think could be in this week's ECB as well, the new SAR forecast. So we have to pay. So maybe that's where we have to be careful that if Draghi doesn't need to do it, maybe the STAR forecast could do it, depending on whether they downgrade CPI again or whatever. So we have to sort of be on our guard if something comes from that side. But really, I just can't see much happening. I really can't. But the last thing I say is I'm crap in ECB, right? Yeah. I lose money 7 from 10 ECB. I make money 7 from 10 FOMC. Okay. Yeah. What will I be doing on Thursday? Not trade the euro. Point blank. I trade the euro if Draghi tells me sell. Then I sell, right? Yeah. So if he goes like everything is rubbish, then I sell it, right? Other than that, you will not see me trade the euro on Thursday. That's a promise or a statement or both.
Yeah, I mean, absolutely. It's I don't see. It's just a mess, really. I mean, I just want to quickly jump to the latest on Trump. So just I'll probably forget before we go into more central banks. I just see I see any news coming out on Trump as a bit of a, well, it's happened before. There's no smoking gun yet, and he survived it so far. So I don't see any negative on that. I know, if it's not Mueller, if it's not his ex-lawyer, if it's, you know what I mean? If it's not him and the porn star, if it's not, everyone knows what he's like. So it's almost like, where's the smoking gun?
Yeah.
So I'm not sure that'll move it, the market.
Yeah. What I agree with Cohen, people will be careful because he doesn't have that much credibility. The story I sort of saw earlier about the House investigating whether the Trump obstruct justice. That could be a slightly different story.
Okay.
But whether it has any impact or not, I really don't know. It's just there's a few things coming to Trump hot on the heels of the kind of failed Korean summit, which the hopes was that we could actually, for the first time, have peace, as in the official peace. They're still at war, right? So the hopes of that summit went as far as a peace treaty between Korea. So that's sort of fallen flat. Maybe he had his valid reasons. Maybe no one blames him for it.
And Dollar Yen didn't do anything.
No. We had to be honest, we had a quick dip in Euro Yen when I bought half my Euro Yen back, and later that day I go like, why didn't I buy all back? The reason I didn't buy all back is because I thought it has to go down another 50 points on that news, which it never did. That's right. No, that is actually, you just mentioned an interesting point. What the market has done in the last 2 weeks is ignoring a lot of negative news.
Yeah.
Now, I don't want to overstate Pakistan and India, but you know what? It's the biggest escalation in 40 years on that border. There are 2 nuclear powers that hate each other like crazy. It's used to be that the market kind of pays attention rearranges risk a little bit just until they understand what's going on. Now it's just like, well, we don't care, right? So we had 3, 4, 5 elements of news that isn't that great. Doesn't need to be turbo bearish, but isn't that great, which we completely ignore. So that is another thing that just makes me feel a little bit uneasy, because it's not normal.
I know, which all goes in line with people wanting to buy that risk, in a weird way. Like, if you can't go down on negative news, then you've got to, you know what I mean? So I don't know, mate.
Fair enough. Absolutely.
So we're gonna sort of come to the piece de resistance, the ranking of central banks, and I'm going to start by saying I've chosen my best central bank, and before I make the case, I would like to hear your case. Who's the best central bank in the world, Beat?
Right now?
Right now, right here, right now.
Well, I go with my friend Powell.
Oh, you read my notes, didn't you?
You know what I like about him is the story I sent out last week or the week before, that you don't have to have a PhD anymore to understand the Fed. That is exactly down my alley, because I totally agree. This is what we discussed back end of last year, that actually, maybe he is indeed just pragmatic, right? Maybe he is. Maybe he's not dovish, hawkish. Maybe he just says as it is. And this report was actually very interesting. It did actually prove, from a scientific point of view, the difference between Bernanke, Yellen, and Powell, and that Powell was the least academic explainer of a Fed meeting, right?
Yeah.
And even people like myself can actually understand it, and so that's why he gets my vote. Okay. I like it.
All right. Well, I join you on that. I've got another reason, which is, I think, significant. But the only bad thing I'll say about Powell is he came in, and rightly or wrongly, we all thought he would not catch the market, and rightly or wrongly, he's caught the market through verbal intervention, and rightly or wrongly, we thought he wouldn't take any kind of pressure from Trump, and rightly or wrongly, you could argue he might have done. And that could be a perception from myself and other traders that say, hold on, that's not correct, that's this, that's that. But anyway, that's the only thing. But overriding all of that, have you got your email pinged on, mate? Because
just give me 1 second. I just had to quickly cancel a few stops that I have in, because the market is still a bit too wide for my taste. So now I'm done with the cleaning. That was just cancelling a lot of stop losses.
Here we go. Well, it's good that you can multitask. I'm really rubbish at doing more than one thing at once. So what was I going to say? Yeah, the big thing about FOMC is the best central bank in the world, and here's the reason: they've got the bullets.
Yeah.
They've got the bullets. Look how many they've got. QT. They've got hikes. They've got 8 hikes. Yeah. So when it all goes pear-shaped, if we're in a recession, they've got room to reverse, and that's the main reason for me. Okay, so the second, let me just get my notes. The second best central bank of the world is, what's your second one after the FOMC?
The Bundesbank. Now, to be honest, I actually never thought about it this way, to be honest, because the Fed is so all dominating in our world, and if you talk about RBA, it's really about the Aussie. And if you talk Bank of Canada, it's really about the Canada. So there is really just, actually there's three important central banks only. It's the Fed, the ECB, and PBOC for the broader market. So then I put PBOC second.
Now, yeah, I don't know. I'm not going to
Really
ask you again because you're copying my nose. You're stealing my thunder. This is like, no one's going to believe us. I thought the PBOC is the second most effective, brilliant central bank, and I think it is because, well, first of all, they're the most powerful central bank in my eyes, just because they can do what the hell they want.
Yeah, true.
And the other thing is they had 4 RRR cuts and a splash of liquidity. And at the moment, this kind of the talk, Danks Bank, we're talking about a credit splash, metals higher, the deleveraging, and the laws on the corporate bonds relaxing. So some of this is starting to feed into the economy. However, I know about the calendar, which we mentioned last week. So the jury's still out, but it looks like they have done enough so far. Let's just see in the next month. But certainly, I would say they've done QE, a smidgen of QE by stealth.
Yeah.
So you could say, look, okay, maybe they've done enough. Big problems not going away. Obviously, zombie banks. Zombie companies. I didn't say banks. Zombie companies, shadow banking, and all the rest of it is not going away. But at the moment, I think they've done enough for the global slowdown. Well, let's see. But certainly, up there, I think.
I mean, the one thing we should maybe quickly mention as well, so we have RBA on Monday.
Yeah.
Really big to expect. Bank of Canada on Wednesday. So that's going to be an interesting one after the weak data from Friday. And we've spoken off air about it, and I think we briefly spoke last week about it, that we both, I think, felt that maybe Bank of Canada is going to be the next central bank that's going to fall in line with the rest of them, which means, like, so far Bank of Canada is the only one hiking, the only hawkish central bank, and I think Canada can't be an island, which means maybe this week is the first week where the language is going to change. I think Canada is going to suffer because the market has been buying Canada for the last 8 weeks quite aggressively, and I think there could be some pain for Canada longs coming. So there's quite a catch up to do, I think, on the Canada dollar if they go to neutral, same as the Fed gone, because they really had quite a bit of dollar or Canada buying going on for such a long time on their policy. So that's probably the more important, or let's say the more interesting one to watch this week. Maybe more interesting than the ECB. At least we get a move, maybe.
Yeah.
Maybe we get one in the euro as well. But it's actually interesting, like, since we talked, so the Aussie has just gone up to like 71.15, which closed at 70.80. So Aussie is bid, euro is just not moving as usual. That pushed Aussie yen up about 30 points now on the open. Canada is not doing much. So yeah, Aussie is suddenly lining up this good old risk on as well on the open without actually any news whatsoever, which is interesting.
So the third central bank, and then we get the fourth one, the worst central bank, because I just picked 4 central banks.
Okay. My third one will not be on your sheet, for sure not.
We'll see.
It's the SNB.
What?
Swiss National Bank.
Oh, don't even mention.
The largest hedge fund in the world.
The biggest hedge fund in the world.
Yeah. $700 billion hedge fund.
Yeah, I know. No. Oh, right. Okay.
So
The
what's
worst
your
one we both can agree on, I think, is
the ECB?
ECB.
Let's just, okay, we have to be a little bit fair to Draghi. Let's
Yeah.
say currently, right? Draghi did save us a few years back with the whatever it takes. So
Yeah.
I give him that credit, which I think no other ECB central banker would have done that. And so that credit he deserves. But right now, but it's like what I'm blogging about all the time. And I told the ECB myself on numerous occasions that, the problem is the ECB is modeled on the Bundesbank. Because when the euro was formed, the biggest concern they had about forming the euro is about having Italy in there, all these club med. So what they done is they modeled the ECB on the Bundesbank, thinking, okay, Bundesbank is that. To be honest, the Bundesbank had more respect than the Fed, right? Bundesbank was the absolute number one. And obviously, Bundesbank is an inflation hawk because obviously historically about the 1930s. So somehow in all this modeling the ECB on the Bundesbank, they only focus on CPI. And to this day, I do not understand why, the euro area, that's such a large tanker, you can compare it with the US. The US has weak states and strong states. You could compare some states with Italy and other states with Germany, right? Exactly the same makeup. Now, the dual mandate just gives you more flexibility. The ECB could have hiked rates twice last year on the back of the strong recovery, strong PMIs, and so on and so forth, and the situation would be completely different today, right? And with the single mandate, and you know what? On top of it, the euro CPI is too strongly correlated with energy. Something in the index is wrong. Because if you remember when oil crashed,
That's right.
the ECB, they couldn't almost be that fast to cut rates to run after the oil price. And so that's just all a bit odd. But it puts them in a straitjacket. And their inflation target is 2. So if they want to reach it, then they have to either have a weaker currency or weaker rates. One of the two, right? Or grow actually kicks in. So I think the final word isn't spoken with the ECB, I think.
Yeah.
But the one thing to look out for in the ECB, it's not a short-term story, is who is going to replace Draghi.
When it comes up at the end of 2019, isn't it?
Yeah, autumn, I think. Autumn, I think that's why they have this rate hike plotted in for autumn, because it's not going to be Draghi hiking.
Not in his watch.
No. And so the replacement will be, I think Weidmann was in the running for quite some time and the euro area recovered. So then the ECB felt they need a hawk, right? So German to be at the helm to do the normalization of the ECB policy. Now you suddenly in a situation where you don't really need a hawk. You need a moderate, right? You don't need a dove, but you don't need a hawk. So the replacement is going to give us a little bit of an idea of what we can expect from the ECB in the next 2-3 years. Moderate kind of, whatever can kicker, or someone who goes like, what, we have to normalize policy. And I think Weidmann is probably just out of the running by pure, weakness of data.
Yeah.
And that's why Draghi came to the helm. Now, don't get me wrong. They needed the duff. At least they done the right thing by getting him in, rather than one of the hardcore Europeans. They will probably have done QE far too late, if at all. We probably have a different discussion, right? So that's the only thing I think, have a plan where they put the sort of successor in what they see as the job of the central bank of the next 3 years.
Well, what they've got no ammo though. I mean, if they start QE4 or whatever it is, I don't know, or whatever. I mean, they can't do anything.
No, I personally think that they are fine with their instruments, because reality is the only thing that you try to keep open, and that's something the US didn't have, the LTROs, TLTROs, and so on and so forth, is all they have to do is keep the channels, the pipes open. You keep the pipes open with all these additional non-standard, products they have. So you don't need just to do QE. You just can go to the banks and hand them some money over like they did before, right, with the LTRO, if need being. Because what they know is, if they can double their QE, it doesn't change the economy. I think we know that much. So the only job the ECB will have, if things turn down again, is to keep those credit pipes open. They can do that with their normal, other facilities they have. That doesn't need to be.
My thing is, if CPI can't go up after the wall of money they've given everything, if there's a global slowdown, which is very likely, and we're end cycle, so CPI is going to tank because not because of Europe, because of the world. What are they going to do to keep their single mandate?
Euro.
Yeah.
Because that's a discussion I once had where I actually accused the ECB when I was in one of these meetings, and a guy from the ECB held a presentation about what the euro is and what the job of the ECB is, blah blah blah, and that they have no foreign exchange target. Then I said, yeah, listen guys, your CPI is undershooting. You cut rates, your CPI is undershooting. That actually is a few years ago. And I said, you have no other choice. You have to start, or you have to tell your boss to start talking down the euro, right? Because that is the only, so the euro is a mechanism that they can use when all other resorts kind of be done or fail, right? And funny enough, a few months later is when Draghi started to be dovish, and I think euro sold off a total of about 10 big figures after that, because that was the only thing left to do, was to get the euro lower, right? I think when they had this verbal intervention near 120 or whatever, I can't remember when exactly it was. But
it was around that,
yes, they don't do currency policy, but then they just talk dovish like shit to get this euro dollar down,
But if he's got to lay it on. He can't be talking about telltale.
Right. But this is too early, right?
Really so, it on. It's almost like he's. But the thing is, if he lays it on, he's painting himself in the corner. He's got to mention some proper words there.
Right now, I think the only thing that can help him is time. And as at least they can be happy that this sort of Fed moving to pause hasn't really caused a damage to the dollar. If the euro would now be 118 on the back of a reaction from the Fed,
I know.
We would have a different discussion, right? So I think euro here is kind of okay for the East, right? They know they're not going to get a 105. They're happy it's not 120. So I think right now this is probably a discussion to have in a few months' time. Probably not for now, not yet.
We'll do a special on the ECB.
Yes.
About that.
I'm well off it.
That is a brilliant show. Thanks, Beat, as ever. We're going to wrap it up now. We could talk all night. I mean, there's so much stuff out there, and certainly, I come in to these. We've been doing these webinars. I used to do them on my own, and having you on the show, Beat, has just made me question myself and my knowledge. Obviously, you're a wealth of knowledge yourself, and that's what it's all about. Just to, I always try and question myself every day, and I encourage all my students to do the same. And I know you do with your students, Beat. But before we go, Beat, you've got some great news about your new website with a new click button and your amazing commentary. Tell us more.
Yeah, thanks a lot. Yeah, so I'm sort of branching out. So I'm still doing, I refine it a little bit. So I do the 4-hourly daily charts, just sort of for the 4-hourly for the day traders, the daily charts for the macro guys, running sort of my thoughts, a piece I write, my 2 cents, which is just sort of summing up my thoughts, where I think things are going. And I put that all on my my website, macrobeat.co.uk. People can sign up there for free for, you know, a 1 week free trial. I added actually to the website, no obligation, no credit card. So no one should worry that, you know, no, I'm not the FT that give you a 1 week free trial, and when you forget to cancel, you suddenly have a subscription for a month. So it's absolutely no obligation. Have a look what I'm doing. If you like it, we can have a chat, or you can speak to Patrick. Otherwise, we take it from there.
Fantastic news. Well, that's it for the show. Please leave comments. It's really important we get all your feedback. If you want us to answer some questions, let us know. Give us a like. You know, just say you thought it was rubbish, whatever. It doesn't matter. We'll still keep doing it. And you know, thanks for watching Making Sense of Macro, the central bank special. Beat, it's good to have you.
Thanks very much for having me, Patrick.
Thanks very much.
Have a lovely evening. See you.
You
Bye.
Take care.